Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent, licensed in all 50 states. I want to welcome every single person on all the major podcast platforms and all of you maniacs on Fun with Annuities YouTube channel, where you can see me wearing a customized Stan, the Annuity Man sweatshirt that's been tie-dyed. Just incredible, the fashion statements that I make every single day. And then over one shoulder, you see 4 Flying V Gibson guitars, which is the reason is it's kind of me saying we're getting ready to rock and roll. And when I say that, I have a rock star on with me today, a repeat guest host. I mean, every time I'm looking something up on annuities, I see an article he's come up with. And, as I say, I've got a new saying for him. If it's time to do some annuity Finke, let's bring in rock star Michael Finke. Hey, man, how are you?
I'm good. How are you?
I know.
Stan, where's my swag? I
know,
I
man.
want a tie-dyed Stan the Annuity Man t-shirt.
The question is, before we get started, is if I put that up on eBay, how much would it fetch?
Yeah.
I'm thinking thousands. I'm thinking there would be an absolute bidding war.
Right.
Well, there's 2 people that bid on it. First, people that actually like the brand, and those are consumers. And then you'd have a bunch of agents that would bid it and then burn it, have a ceremony. And that's okay. That's okay.
Good to talk to you again, Stan, as always.
Thanks, man. Tell me what's new with you, Michael Finke. What are you looking at other than the conundrum that we're in of large debt, rising rates, and a retirement semi-crisis?
Yeah, well, so let's not start on that negative foot. Let's move to a more positive aspect of what's going on in this crazy market. And that is that near retirees can lock in 5.2% on MYGAs, on 5-year MYGAs for the next 5 years.
At the time of this taping.
At the time of this taping, may go up, may go down. Now let's talk a little bit about interest rates, because I think
let's do that.
If you look at what's known as the yield curve, which is the interest rates that you get for investing in 2 years and 5 years and 10-year bonds, what you see is that the market thinks that these high interest rates are not going to last forever. There's what's known as an inverted yield curve on bonds. Correct. So what that means is that once you go 10 years out, the markets actually think that interest rates are going to be lower than they are for the next 2 years.
Yeah.
And this presents a conundrum, I think, for a lot of investors right now, which is it seems like we've been waiting forever to get high rates of return on safe investments. And as we know, annuities are a very efficient wrapper for safe investments, because safe investments are very tax inefficient. So your bond, your CD investments, they get whacked. You're taxed at your ordinary income rate, state plus federal. So for some people, if you live in California, that can be 50% of all of your gains you're paying in the form of taxation. But if you house them within an annuity, you're not taxed on the gains every year. Now, when annuities were maybe 2%, that was not a huge deal. But when they're 5%, that all of a sudden becomes a bigger deal. So if you put in $500,000 and you're making $26,000 of interest on it, that's a significant amount of tax savings that you can get over the course of a 5-year time horizon. I mean, that's over $125,000, $130,000 in interest that you can expect to earn. And then at retirement, so this is the play that I think a lot of people are not giving enough thought to. If you're 62, 63, you're the peak of the baby boom right now, you're planning on retiring between 65 and 67, you buy one of these things, you pull the money out after 5 years, you're in a lower marginal tax bracket than you were today. And the interest may or may not be enough to push you up into a higher marginal tax bracket. If that's the case, you can roll over part of it into another type of annuity. You can be very strategic about your tax planning in a way that you can't be if your savings is not within the annuity structure. So, a lot of us are thinking also of locking in those high rates on future income. So again, if you're
Correct.
55, 60 years old right now, and I just had a conversation with a friend of mine who works for a big brokerage company, and he gets these quotes in on annuities every day. And he's a smart guy, like he understands the benefit of annuities. And we're both like, he's a little bit older than I am. And he's thinking, I need to just take money and buy one of these things, like a 10-year deferred, so that I can get 10 years of deferral at a really shockingly high interest rate.
Correct.
And then it'll buy me a very high income in the future. So if I can, a great example of this is like QACs. QACs is so interest sensitive that it used to be that $145,000 might buy you $35,000 or $40,000 of income. Now it'll buy you $50,000 of income at the age of 85.
That's right.
All of a sudden, it's like I can buy future lifestyle pretty easily. And we're in a situation today where it's far more attractive than it was a year ago. And we just don't know where rates are going. I mean, it's looking like the Fed is potentially going to increase rates. None of us know exactly what's going to happen in the future, but there is also this possibility that we're going to enter into some kind of a recession. The Fed is going to very quickly start pulling back on those rates because it's seeing that the economy is starting to cool significantly.
Sure.
In which case, locking yourself into today's high rates, I mean, it's possible they could go up a little bit, but it's also possible that they could go down.
The bell doesn't ring at the top. The bell didn't ring at the top, man. You know that.
And how quickly those things get repriced.
Sure.
Once things start falling, then insurance companies are very aggressive about reining in some of the generosity if interest rates start going down. So and I think that probably right now the biggest story for me is that tax deferral benefit that you get from an annuity that you don't get from CDs. And a lot of people are feeling like, I don't want to deal with all this market volatility. I want safety. But the thing that you have to remember about safety in a high interest rate environment is that you pay for it. You pay for it in the form of higher income taxes. So you've got to give some thought to using an annuity. I think the annuity wrapper on safe investments, the single most underused strategy in financial planning today.
Sure. That's because people, when they hear the word annuity, they think it's one product. They don't know that there's multiple products. And so
I think there's high fees, and then on a multi-year guaranteed annuity, it is what it is. Like you get your 5.2%, there's no extra fees on top of that.
Right. And, I'm a big proponent of what I call MYGA to SPIA. I did a video on it that kind of went viral. Let's strip out all the fees. You have control over the asset. You can pivot at the end of the duration, or you can transfer it and shop for the highest contractual guarantees at that time with an immediate annuity instead of buying a deferred income annuity or an income rider. A lot of people are looking at that. And the other thing I would always tell people, Michael, I'm from the deep South, so I think differently. If you won the game, why are you still playing? And I always tell people, if you got $1 million or $2 million, whatever it is, whatever the amount of money is, and you multiply it by 5 or 4, if you're going to, pepper it around with CDs and treasuries and never touch the principal, can you live off that interest? It's really that simple. We're at the point now where people can actually live off the interest. Is it Jimmy Carter years? No, but we haven't seen this in a long time. So it's a different, and I think a lot of people are looking at MYGAs, multi-year guarantee annuities, which is the annuity industry's version of a CD, and they never ever heard about it before, which is interesting.
It is interesting, but Stan, they've become a lot more popular. I just looked at the sales data in 2022 so far. Those fixed annuities, they're dominating.
Half of that was me, Michael, just letting you know.
I'm not surprised.
We ton that, and we've been doing that for a long time. What people have to know is the commissions for all annuity types are built in. MYGA commissions are just very, very, very low. That's the reason the Bad Chicken Dinner seminar isn't given on MYGAs, because they don't have that. What else is, you wrote an article recently about wealthy people and annuities. I forgot the title, but I read it and it was pretty interesting. What drove you there to talk about those rich, evil people, Michael?
Well, no, what I was actually talking about is a new study came out from Morningstar. And when Morningstar comes out with a new study, a lot of people pay attention to it. And one of the things they said was that for Richer people, annuities don't really provide that much value.
But we got to define rich. What's that mean?
Well, I mean, for them, it was, people whose assets are maybe 25 times what their income is, but that includes Social Security. But the thing is, the problem that I had is the methodology. And,
I just pointed the first one out. I mean, some people think they're rich and they have X amount, and other people would think that's poor. It just comes down to the customization of it all.
And the question is, what is the welfare benefit from? And it's kind of a economist word, like how much happier does it make you?
Is that what welfare benefit means? Because that's a horrific phrase.
It is a horrific phrase, but it's used by us economists all the time. We don't have
to up your game, man. Y'all need to bring me in and give you Southernisms, like Southern sayings, because we would never use the word welfare benefit, man. Hey, you're getting a welfare benefit, and people are like, I'm never going to be on welfare ever in my life, son. Let me tell you something, I'm a working man, son. I mean, you gotta rethink this stuff.
You are absolutely correct. Our marketing skills are not that great.
Horrific.
But the idea is that a lot of times in financial planning, what people use are what's known as a failure rate analysis. They use a Monte Carlo. Oh. And what a Monte Carlo does is it spits out this number, which is the probability of success, which means it's the probability that you can successfully, from an investment portfolio, withdraw a certain amount of income. So let's say
I like Monte Carlo as a place and as the race. That's kind of played out though, isn't it? All these, I mean, seriously.
Well, that's why economists don't use it, is that it gives you information that is not complete. So what it tells you is, let's say you've got $1 million and you want to pull out, what's a SPIA rate right now?
Bad question. It has to do with your age. You know that. That was a setup question. Don't do that. Don't even try to play me, Michael. You know me better than that.
Well, most economists start at like 65. So 65-year-old male.
I'd have to run the quote. Pick a number. Pick an arbitrary number.
$60,000 a year from $1 million.
Okay.
And so let's compare that to an investment portfolio with stocks and bonds. And let's say, what is the probability that you can successfully withdraw $60,000 from a portfolio of stocks and bonds? And then let's use like historical stock return data from the United States from back during periods when stocks really dominated bonds, which, by the way, has not happened since 1990. Here's a stat for you. Since 1990, $1 in the S&P 500 has never grown to more than $7 over 20 years. Between 1934 and 1953, $1 never grew to less than $7 every single year during that time period. Between 1934 and 1953, $1 never grew to less than $7 over the next 20 years. But since 1990, that has never happened once. So a lot of people who use a Monte Carlo are using these data from a period where stocks really dominated other types of investments. And then they project the likelihood that you can withdraw $60,000 from $1 million portfolio using those historical data, which are probably not relevant going forward. And then it spits out, well, there's an 80% probability of success. What does that mean? There's an 80% probability using historical data that are not relevant that you're not going to run out of money. What that doesn't tell you is that when you do run out of money, the 20% of the time using these simulations, you got to live off Social Security.
Yeah, so they say, well, you're toast.
Yeah, that's what economists say is, wait a minute, let's look at how bad things can get when you actually do run out. So, if you buy an annuity and let's say you've got two people, one of them has $2 million of savings. They use $1 million to buy $60,000 of income. The other one just has $2 million and they try to pull out an income. And the one with $2 million tries to match the same income. When they run out, they got to live off Social Security. The one who used $1 million to buy $60,000 of an annuity, they've got $60,000 plus $30,000 of Social Security. Their worst case scenario is that they're living on $90,000 a year. But they might both have the same failure rate, where the one who bought the annuity might have a lower failure rate, depending on how you model it out, or a higher failure rate. But even if they do, what's the consequences? So when you buy an annuity, especially if you take part of a chunk of your savings and buy
And
an
you're
annuity,
talking about, when you say annuity, you're talking about lifetime income annuity.
a lifetime income annuity.
Yeah. Okay.
Yes.
Great. Okay.
And let's say, you take a chunk of your savings, you use it to buy an annuity, you're essentially buying yourself a minimum standard of living forever, no matter how long you live. And so if we model out 1,000 different potential retirements, the ones who will have an annuity will on average be happier. But the ones with an investment portfolio might have a slightly higher probability of success, but there's no information about what failure means.
The community college version of what he just said was, you either want to shoulder the risk or transfer the risk. One of the two. It really comes down to. And yes, community colleges are great because they teach trades, Michael. I mean, we need plumbers. We need plumbers and electricians and things like that. What's the probability, Michael, of me having six-pack abs? My wife wants to know. Can we run a Monte Carlo on my abdomen muscles? It's not good, is it?
Allergy here.
I have to, man. Listen, you come on the program, I'm going to push the envelope, man. And I'm thinking to myself, can you run a Monte Carlo? There's no chance that this person here in this nice red tie-dyed thing isn't going to have six-pack abs. But that's all I care about, Michael. Can I have six-pack abs? Okay. That's why when people call me and they'll say, well, this guy told me that this annuity do this and this and this and this. I'm like, listen, you have a better chance of having six-pack abs. And I don't know you, but you're not going to have it. So I tell people that's my analogy to the too good to be true sales pitches that are out there. So what else is new in the annuity industry, Mr. Finke? What are you working on? What's the super secret, double secret probation project you're on?
Well, gosh. So one of the things that we may or may not have talked about in the past is how having greater guaranteed income actually allows you to take more risk with the remainder of your investment portfolio. I think something that not a lot of people give thought to. First of all, when you buy an annuity, an income annuity, that's part of the bond portion of your portfolio. And again, I was mentioning before that you can use an annuity as a substitute for part of your CDs or your bonds.
Sure.
And you get that additional tax deferral benefit. But something that I like to think a lot about is, okay, you're close to retirement. You've got this asset allocation. You have some of it in qualified, some of it in non-qualified. You start moving the chess pieces a little bit. And how does that impact the optimal allocation outside of those chess pieces? So I have $2 million of savings. I use $500,000 to buy myself an income annuity. What does that entail in terms of what the rest of my portfolio should look like? And what it should look like is if I got a 50-50 portfolio, then I can actually continue to invest $1 million of my $2 million in stocks. I now have $500,000 in bonds. And in fact, I might even be able to go to $1.1 million of stocks and $400,000 of bonds, again, because my safety net that I've built is bigger. The worst case scenario is better. So, I mean, what risk in retirement means is spending volatility. And if you take more risk, you're going to have more volatility of your spending. You're going to have a higher probability that you're going to have to cut back. That's really what risk means. It means that, let's talk also about 2022, because I don't think we've done that. And if you would have started out the beginning of the year with $1 million and you would have done the 4% rule. Say you got two retirees, they each got $1 million. One follows the 4% rule. They think they can spend $40,000 a year plus inflation, $43,200 next year. The other one decides to wait 9 months to retire. And they had $1 million. Now they've got $800,000. And the financial advisor tells them, no, we're going to follow the 4% rule. You can spend $32,000 a year plus inflation. That doesn't make any sense. This guy over here started with $1 million. He's now down to $800,000 minus whatever he spent over the last 9 months. He's got even less money. And you're telling him or her that she can spend $43,200 next year. And the other one, you're telling you can spend, $32,000 plus inflation next year. You have to be willing to be flexible when it comes to spending if you take investment risk. And I think oftentimes people don't really fully understand that. And I think people are beginning to become aware of it. In fact, when I look on the boards of retirees, what I'm seeing a lot of people talking about these days is I did not know this could happen. I started, my advisor
Yeah.
said I was going to be fine.
Yeah.
I started out with this nest egg. I reached my goal. You know, a lot of people hit their goal number in 2021. They decided they were going to retire.
Sure.
Now they get a lot less money and they're saying, I got to go back to work, or my advisor's stupid. You know, they put me in these things and they didn't tell me.
I like the my advisor's stupid broad brush, because that's pretty good. Of course, that doesn't include me. But yeah, I do like that. Now,
Well, I
I was
mean,
going to go ahead.
It's the market, right? You know, all
Exactly.
everybody that was in the market lost that money. I lost that money. You lost some of your money. I mean, we all lost
I don't
money.
do markets. Come on, man. I only do contractual guarantees. But I will tell people that most advisors today, I have cowboy boots that are older than them. They have only seen bull markets. They have not seen
Right.
people walk out in the front yard and vomit. You know, and I started in the securities industry in '87. If you that year rings a bell, there's a reason. You know, markets don't always just historically go up and up and up and up quickly. Over time they do, but I think for the baby boomer, the conundrum, the head scratcher is, what do I do here? Do I have enough money to win the game and just peel off interest or create an income floor? Or do I still want to play the game?
Mm-hmm.
My opinion, Michael, is, you know, the whole people saying to everyone, well, you got to go to college, you got to buy a house, you got to get a dog, you got to be in the markets. Do you? If you have enough money and just want to peel off interest or create a lifetime income stream, do you really need to be there?
It's a great question. And I think most of us who have taught, I have friends, obviously, we're this group of retirement dorks who talk to each other about what we hope to do with our own retirement.
Is that retirementdorks.com?
Yes.
It needs to be.
It's a special club. You're invited, by the way, Stan.
Are you calling me a dork? Is that, wait a minute, swallow down.
It's a term of endearment.
Okay,
it's an exclusive club.
Oh, thank you very much.
But we all, I mean, when it comes to our retirement, that's how we want to play it. Like we can take risk during the accumulation stage, but when we get close to retirement, I just want to lock it in, and I don't have to think about it. I don't have to worry about what's going on in the markets. When I'm deciding whether or not I can go on vacation next year, I don't have to say, well, wait a minute, you know, the markets are down, I'm not going to be able to do that. I want to be able to lock in as much as I can lock in without the fear. And I know the older I get, the more it's going to bother me. And that actually shows up in the data, is that we do get.
And you're like 32, right, Michael?
Absolutely. Yes. How did you know?
I don't know. I just took a stab at it. Just your voice. No, I'm kidding. You know, I always tell people there's no U-Hauls behind hearses. I'm trying to figure out how to quantify that with a formula. But I do think that people, and I'm pounding the table a little bit out here for the baby boomers to consider and look at their situation, that you might not only want to retire from your job, you might want to retire from the markets. If you can. A lot of people can't, but if you can, and I think that these choppy markets, and I think we're getting, at the time of this taping, I think people are listening to Stan the Annuity Man, because, you know, it's lifestyle in chapter 2 of your life. So what are you and the dorks doing to get this message out? Retirement dorks. I've got to go get that domain. To get the message out in English to people, not, you know, I'll let you finish that question. Here's a great comment. Guy was calling me the other day, and he was looking at an annuity product, a very complex one. We won't mention it. And his comment was in Southern. He goes, you know, I didn't know mathematical formulas had letters in it. I'm like, it does. Okay. And that's not a good thing. So what's the messaging that we're trying to get across, other than just hiring me and paying me a huge retainer to do it right? What are you guys doing?
You know, one of the things that I'm a big fan of is telling people, if you try to do it yourself, first of all, you have to pick a failure rate, a probability that, you know, what age do you want to run out? Oh, by the way, this is all prefaced with a discussion that begins, you're going to die. So I have a friend of mine who's a researcher.
That's beautiful.
Yeah, he's a researcher who studies this idea of people's unwillingness to accept their own mortality. Yeah. And whenever anybody brings up anything, I mean, there's a reason why it's called life insurance and not death insurance. And even though it is death insurance, It's because people don't want to acknowledge the fact that they're going to die. But if you're going to do retirement planning right, you've got to acknowledge the fact that you're not going to live forever. Hopefully, you're going to live a really long time, but none of us know. So there's only two places your money can go. Your money can either go to other people. When you die, your money gets spent. All that fun that you could have had gets spent by someone else.
My daughter showing up to my funeral in a Lamborghini. That's what's going to happen.
It is. And it's actually, the research is so much fun because when people get these inheritances, it's always the ones who like having a whole lot of fun who spend it down the fastest. And they're the ones, every generation has those people who didn't really accumulate much money in their lifetime, but when they get the money, they know how to spend it. Like they know how to live. So either the money goes to that kid who is really good at spending money, or it goes to your lifestyle. And if it's going to go to your lifestyle, you got two choices. You can try to spread it out, or you can buy yourself some sort of a guaranteed income product that allows you to spend. We've talked about this before, the birthday cake problem. It allows you to spend more every year without having to worry about potentially running out. That's why you do it. That's why economists say it's a puzzle that we're not buying more of these things. But I think the big thing you have to overcome is recognizing that you're not going to live forever, and you either have to cut little slices of the birthday cake, or you can spend more with less worry. So why not just do that?
What worries you, Michael Finke, other than waking up in the morning and just continuing to be vibrant and young?
What worries me, frankly, right now, and it's probably the same thing that you mentioned at the very beginning of the podcast, which is one of the consequences of really high interest rates, the Fed raising these rates, is that it's crowding out everything in the federal budget. And
absolutely,
that makes me worry about spending austerity, which is another one of those fun
holy
words
crap
I love to use.
That sounds like an affliction. Like the fact spending austerity means that I've got money, but I don't know what it's for. That's what that means to me. I don't need, y'all need to come up with.
The federal government only has so much money it can spend. And if it's spending a ton of money on interest payments, then it's not going to be able to spend as much money on things like generous Medicare and Social Security benefit increases over time.
That's good. That's good. I love your phrase. You guys need to come up with these phrases and then sell t-shirts on retirementdorks.com. Spending austerity. What was the other one? Welfare. I've got I mean, it's just like, what in the world are y'all talking about, man?
Economist jargon.
And then I'm over here doing all the southernisms, like, squeezing oil out of a brick. That's what we're doing right here. We're trying to get the highest contractual guarantee. We're squeezing oil out of a brick. But I think that's part of the annuity industry's problem, is we have not messaged it right to people in English that they fully understand, because the way that we talk about it seems complex, but truly annuity types are very simple if explained properly. This isn't complex.
They really couldn't be any easier.
I always say, if you can't explain it to a 9-year-old, don't buy it. No offense to 9-year-olds. It really is that simple. I mean, because everyone's, well, they're expensive and I can't understand them, and I'm like, I told a guy the other day, and I was trying to explain MYGAs. And I told him, I said, I'm a little frustrated. I feel like I'm showing a painting to a blind person, because they just didn't understand the correlation between CD and MYGA. I'm like, it's really that simple. Don't make it any more difficult than that.
Right.
And so that worries you. But what makes you get up in the morning, put on the running shoes? You run 7 to 10 miles every morning, as you know. After that run, what makes you want to just go get it every day?
I got to keep up those 6-pack abs, Stan.
Yeah, man. I mean, you're kind of the idol that I'm looking for. So what motivates you? What keeps you going, Michael?
Well, I mean, first of all, we have this huge baby boom cohort, and I worry about them, frankly. I think that it's the first generation that's going to have to rely entirely on savings to fund their lifestyle. I think they had a really great time back in 2021. The markets were doing fantastic. All of them felt really rich. But I was really worried then. And I'm worried that they don't have the right information about what they're supposed to do with that money after they retire. I think we've really dropped the ball as a society on those retirees. We don't have any moment where we sit down with them and say, all right, you got this pot of money. what do you want to do with it? What's your goal? How do you want to live? Like, let's start with the lifestyle that you want to lead, and then let's build that plan around it. And to the extent that I can educate people on making some of these choices, I see it as an opportunity to help people live better. But I think they just have no idea. They don't understand what these trade-offs are. Again, to an economist, it seems pretty easy. You know, you've got these very easy to understand trade-offs that are all about welfare maximization, but to the average retiree, they have no idea what it's all about.
Welfare maximization.
So it's our job to try to use concepts to help people put together a plan that's going to make them happier.
I could get elected running against the phrase welfare maximization. Just bringing it up and say, I am totally against welfare maximization because I'm tired of giving this stuff away. You know what I'm saying? And then you step in and go, like, Stan, that's not what I'm talking about. That's not welfare maximization's all about.
I am not running on the welfare maximization platform.
That's a loser. But you know, it's interesting.
Kind of messaging that usually works.
That's pretty. But people always talk about fake news and political fake news and all this stuff. Financial fake news is as bad. It's as bad because and I want you to think about it from a party standpoint. You have the party over here of contractual guarantees and the curse word of annuities. Then you have the party over here of market growth and potential, and it's going to go up. And both sides hammer each other. Both sides say things about each other that are unfounded to get the sale from the other guy, similar to a politician saying what they have to say to get the vote. That's the problem. The problem is the master of the universe, financial architect, wealth architect, financial advisor saying all annuities are bad. I'm just telling you right now, son. And that's stupid, as if I said all mutual funds are bad. That's stupid. And I think, I don't know how to cut through that noise, but other than, you know, the annuity industry is notorious for sponsoring the Rolling Stones tour, which is, I don't understand that unless I'm opening for them. We need to do a better job of buying airtime. I would think, you know, I've seen some stabs at that. I know you sit in the big boardrooms with big marble stuff and they feed you all these really nice food and stuff. Has anybody talked about actually marketing to the boomers other than what I'm doing?
Well, Stan, I have to say, that's why I mentioned to you before this interview that I actually used your name in a very important group early on in this week.
Did they boo? Just tell me the truth because I can take it.
They were all right. They hadn't heard of you, Stan.
What?
They don't know to hate you.
You got to be kidding me. But then again, I don't market to the financial industry.
No, you don't. And so, but no, this was more like policy folks from big financial companies.
Oh, these are.
And I'm saying, like, you've got, this is how you need to present this information. It's simple, it's straightforward. I used examples of the way you present information on the website because that's what the consumer needs to know. Is they need to know, you know, the quality of the different insurance companies. They need to know the quotes that they're getting. You focus on very simple products that are very easy to explain, that are providing the kind of lifetime income that people actually want. That, you know, it's something that I think others could learn from. I'll say that. That's the ultimate compliment, by the way, Stan. I think your marketing skills are exceptional.
I need to go speak in front of this group. Now, I would do it with a drummer behind me, you know, doing like a hip hop drum beat as I'm talking. And maybe a guy on guitar. But the point is, it would be neat for me to talk to these. I did it one time at like the Association of Financial Planners in Chicago. And they brought me in, they paid me, and it was like 1,000 people in the room. It was like a fist fight the whole time. Of course, I won every one, but factually. But, you know, it was bizarre. It was interesting. But I think that's what needs to happen. We need to go into the belly of the beast, as they say, and factually hammer them on what this is all about and have the people step up to the mic and try to, you know, stump Michael and Stan. And we just go, sit back down, chump, because we're getting ready to kill you right here with facts.
You know, I don't see the same level of antagonism towards annuities.
Come on, that's what makes it fun. Just let me go. Let me have it. Okay, I hear you. I hear you. You know why? I'm going to tell you why.
In general, and that is great to see, because I think especially in the investment world, people were not as open to having these kind of conversations maybe 4 or 5 years ago, but there is a general acknowledgement. Yeah, these things actually have a place. Let's think about how we can position them to consumers.
Well, there's a demographic tidal wave, and I've got a feeling that a lot of people are walking in, whether it's from a bad chicken dinner seminar or just life, saying, I'm really tired of the volatility. Do you have anything else for me?
Yeah.
I think as like everything that's good, the consumer drags the industry across the finish line.
Oh, I want to talk about one more thing, Stan,
Yes.
before we stop this. So first of all, fixed indexed annuities.
Oh God.
It is, but let's think about this for a minute, Stan.
Oh
First of all,
no, I read Jason. I read his article.
No. The option, but first of all, the option budgets are getting pretty generous in these things, which means that the caps are pretty high. They're higher than they have been in the past. But let's also think about, those guarantees the insurance company provided that you wouldn't lose money on your investment as a bond substitute. So the insurance companies, a reminder about how fixed indexed annuities work.
Wait, stop. I'm going to argue with you here. You cannot put fixed index annuities in the same categories as a bond. You just can't, Michael. Come on, man.
Well, I mean, if you look at the historical long-term performance, they're pretty close to a corporate intermediate term bond over time. But you get this downside protection of the principal. Now, the thing I want to talk about here, Stan, is that with those products, the insurance company has actually lost the money. So
you're right.
They invested in their general account portfolio. They assumed it was going to provide a 5% return. So they took $95 of your money. They are going to give you $100 back next year. They invested the rest in a financial option, which did not pay off this year.
Sure.
But of your bond portfolio, you're not going to lose any money on that. And the assumed rate of return was 5%. The insurance company is now holding all of these intermediate term corporate bonds. They saw this tremendous loss in their general account portfolio that they cannot transfer to you. So this is one of those years where a product like a fixed indexed annuity that provides you with protection against loss, it's become very apparent that you've transferred a lot of risk to the insurance company of your bond portfolio. And I
agree with you. And you said something on a previous podcast with us that I've attributed to you since, and you probably said it by mistake. It was so good, Michael. That's what I mean. Yeah, it was that good.
Thanks, man.
And you said, let the annuity companies buy the bonds for you.
Yeah.
With these products. And I thought that was genius, and it still is genius. And you still get the props and you still get the royalties, because this is a great example of they're buying the bonds for you and you're not suffering in the volatility of the underlying principle of those bonds. Yet you have the contractual guarantees in place. So,
I think this is something that a lot of people had forgotten about. That
agreed.
Agreed. At the beginning of the year, some people thought, well, wait a minute, interest rates are so low. I'm going to buy bonds that have a higher yield. I'm going to buy bonds that are longer term. I'm going to buy bonds that are riskier, lower quality bonds.
Sure.
And those people thought, well, how risky could bonds be? And by the time we get to October, the Vanguard long-term corporate bond ETF is now down more than 30%. Like, who thought that was even possible?
Listen, I was there in the 90s. I was at Morgan Stanley when that happened. And I was a bond guy at those big firms. And I always tell people, bonds aren't always a safe haven at all, from a standpoint of underlying value.
We're definitely seeing that this year.
Oh my gosh. I think we're in a bear market for bonds, and I hope I'm wrong, and who knows? That's from my past, but I don't know. Tell me about inflation, Michael. You wake up in the morning after the workout and then you start thinking about inflation. What are you thinking about?
Well, okay. So inflation has been really spotty. So that means that, when I look at the inflation numbers, what I see is not that everything is going up by a lot. I'm seeing that some things are going up by a lot. And obviously the war in Ukraine has impacted energy costs. That's gone up a lot. There are supply chain issues that are, partially a carryover from the COVID era that are affecting prices a lot. Some things like healthcare that seniors pay a lot of money for really have not gone up at all over the last couple of years. So if you can be more flexible, then which most retirees can be more flexible, then the impact of inflation is not as big of a deal. One of the things I worry about with those retirees is that there is such a thing as inflation sequence of return risk. And what that means is that if inflation is really high early on in retirement, the prices of stuff you buy throughout retirement is going to be more expensive. So it's worse if inflation's high early than if inflation is high late. Because if inflation's high early, then prices go up and they stay up forever. And if inflation's high late and you pay really high prices later on, it's not a big deal because you were able to buy cheap stuff for the first 10 years of retirement.
And you're going to die.
Well, don't remind people because that freaks them out.
As a good friend of mine that does life insurance, he always says, one out of one of us is going to die. I'm like, thanks, mathematician. Appreciate that. Tony Robbins. But it is true. And inflation, I always tell people, if you have enough money, like if you call me and you have multiple millions of dollars and you ask me, let's solve for inflation, I will call you arrogant. And I will start yelling at you at the top of my lungs because come on, man, you can afford the eggs and the bread and the gas. You know, obviously inflation hits people at the low end. It always does. And I always tell people there's no perfect product to solve for inflation. You know, you already have Social Security and you can buy I bonds, but you know, annuity companies have the big buildings for a reason. There's no floating product out there that addresses this, even though a lot of people will say they have it. They do not. In your roundtable of retirement dork geniuses with advanced degrees, what are you guys talking about from the standpoint of future products that you see coming down the pike that should be developed?
Well, okay, so one company has developed a fixed index annuity with an income payment that is actually allowed to float up with inflation up to 5% per year.
I understand. Don't mention the name. Don't mention the name, please. Don't mention it. Don't mention it. Do not mention it.
But they
lower the initial, but they lower every one of these firms that have that, and there's actually 5 or 6 of these products out there, that they lower the initial payment to make up for that potential increase. So you have to factor in the break-even point if you bought a static payment versus the potential hypothetical, theoretical, projected unicorns chasing the butterflies increases that's being sold out there. It's not as pure as you're pushing because Social Security is the best inflation annuity on the planet because there's no actuaries involved. There's only politicians.
Stan, and that is the bottom line, is like, if you're worried about inflation, just wait to claim until you're 70. That's the best way to deal with it. Beyond the options are limited.
Well, I always tell people, you want to solve for inflation, reverse engineer an immediate annuity for the exact dollar amount that you need to fill in the income gap, period. That's it. Everything else is a sales pitch, you know? And so the other thing too is inflation's customizable. So some people it affects differently than others. My 2 daughters have left the building and I don't have to pay for dance classes and drive them back and forth. So there's not as much gap.
Am I allowed to mention that you can even use a QAC as a way of dealing with later retirement inflation?
You are allowed to say that because, you know, I did write the first book on the planet about QACs in 2014, as you know, and it's so well documented. But, you know, it's not for everybody. It is a future income payment that can hedge against inflation. Why? Because you have income starting at a future date, no different than buying an immediate annuity at a future date. There are some tax savings, et cetera. Do you see QACs? Do you see our politicians who we both love, trust, and understand? Do you see them? You're supposed to laugh at that, Michael. Come on, man. No.
It's beyond laughter at this point.
Do you see them raising it to where it's real, like a 200,000 or 250, where people can actually whack it pretty good?
So, I mean, the reason that they would do that is to develop some sort of a workable default in a retirement account. So what is happening right now is QACs have been considered by some companies as a default solution to protect against longevity risk in your 401k. And if you have a high enough income, then you're going to go over that $145,000 limit. Are we going to pass? First of all, you're asking, are we going to pass Secure 2? I don't know. It's like 50-50 shot. And second of all, is that going to be an issue? People have tried to beat me down on QACs Stan, to be honest, that
Not
nobody
me,
really
baby.
cares that much about them. And, making significant policy changes beyond increasing it by the rate of inflation is going to be tough unless it's coupled with some sort of a QDIA solution, like a target date fund solution.
Are you a fan of target date funds?
I am. I think
Are
they've
you?
been, oh yeah. The reason is, and I'm just doing a paper
Yeah,
on
give me
this.
the reason. You sell me on that, because you and Paul Merriman, who's good friend of the show, our target date fund. You probably have a tattoo like target date fund on your arm. I don't know.
Well, no, that's
Why?
just QLAC.
Just why target dates? Sell me.
Because I've seen what people do when they try to invest on their own. So
Oh, it's a loving handcuff, is what you're saying.
it is, and I was just doing a paper. I was talking to a reporter this morning about it, where I look at, for those who have a target date fund, how many of them phoned up their record keeper? Where the record keeper is the one that they need to phone up to make a change in their investments, and half the percentage of those who have a target date fund versus those who are managing their investments on their own, half of them called up their provider when the markets fell in early 2020, and 1/10 of them, they're 1/10 as likely to make a change. And by the way, the ones who did make a change were all pulling money out of stocks at exactly the wrong time in March 2020.
So you're dummy. So what you're saying is a target date fund is a dummy-proof investment.
Absolutely. That is its biggest strength, is that people, it's a set it and forget it kind of investment, and people don't touch it. And they actually outperform the experts over time in these things. It's magic. It's really great. Now, the problem is that it's not customized. It's not tailored for every person. Everybody gets the same thing. It's, and the amount of money that you save, nobody ever figures out whether that's appropriate for you. Somebody with a high income is saving the same percentage as somebody with a low income. That's not right either. So probably the best kind of default is something that's a little bit more customized than a target date fund. But I tell you, target date funds are infinitely better than where most workers were back in the early 2000s. They were either investing in money market accounts, something like 70% of the money was in money market accounts, or they were trying to invest in stocks. And they are so bad at investing in mutual funds. They buy more mutual funds after they've gone up in value. They look at the quarterly statements to see what outperformed last quarter, and then they shift all their money into that, and then it underperforms. So I'd rather people just leave them alone. The best thing they can do is just leave their investments alone.
So if I'm a bad financial journalist, which I'm not, my quote would be Michael Finke, quote, "Target date funds are for low IQ, overly emotional investors," unquote.
Yeah, like me. So I have my retirement invested in a target date fund. Now that I'm lying. Actually, half of it's in a target date fund, half of it I invest on my own. And I was really clever when I had put together my portfolio on my own. I did the right asset allocation. I did. I was very, very thoughtful. Stan, how many times have I readjusted my allocation since I did that 7 years ago?
50.
I haven't touched it. I haven't looked at it, which means it's all out of whack right now. The stock market may have gone up. So now it's really stock heavy, which means I lost a bunch of money when the market went down recently. I'm supposed to be a finance professor who is constantly readjusting my portfolio. But the thing is, there's always something that's more important to do that day, and I never get around to it.
So you're a disinterested economist, is what you're trying to tell me.
I am. I'm not very good at practicing what I preach. And it's, I just don't want to have to think about that stuff, which is one of the advantages of automating it.
I hear you. We've talked for a long time. This has been good. This has been good. So, I'm waiting for you guys to fly me in on the Learjet to take this thing to the next level, the annuity thing to the next level. Because I'm going to do it on my own, by the way.
Yeah, I've got a couple. I'll let you borrow one anytime.
Okay. No, that's cool. Yeah. That's cool. Yeah, I was looking at that.
Us professors.
Oh, yeah. You guys are rolling, man.
In the cash, You
guys are rolling. So, no, it's good. I appreciate you joining me kind of out on I read your article that I got to call him because I was wondering where that was coming from. And you said Morningstar, but that's good. But we always want you back on the show, and we really appreciate you working on this for the baby boomers. All of those people, you are doing yeoman's work. We just have to shout it from the rooftops.
We do.
We really do.
And I appreciate what you're doing as well, Stan.
We're trying, we do a few videos, we do a few podcasts. We try to get it out there the best we can. And I think we're making an impact because people are starting to look at it in a serious way, and the way they should from the contractual guarantee standpoint of these products. I just hope that the industry continues to be push themselves to create better and better products, not just, repolishing up the old stuff, but we'll kind of see. I put that on you. That's what you need to do.
Okay. I'll work on that.
Yeah.
Put it on my to-do list.
Well, listen, I appreciate it. I appreciate every single person on every major podcast platform and on the Fun with Annuities YouTube channel. Yes, you can email me about those 4 Flying V Gibson guitars in the back that you see, and about my band, which, by the way, Michael, at the end of this Annuity Man thing, I will go on tour, just to let you know. So with that being said, we had a lot of fun. We will see you next time on Fun with Annuities.